Hey, today on the show we have a great guest. Spencer Hilligoss is going to be with us, and he is an expert when it comes to playing offense in investing rather than defense. Really having a plan, really moving forward with a goal in mind. And the difference between what you normally hear from us about residential real estate investing, even though Spencer is doing some of that, but their main focus is on basically larger investment things like apartment complexes or storage units or anything on that kind of a scale. And he will tell us during the show, how can you play offense investing in these kind of things and really be successful? So I'm really pumped to listen to what comes out of our conversation. I hope you are too. Hello and welcome to another episode of the Ideal Investor Show. Today we have another great guest here to help us, and that is Spencer Hilligoss. He is an expert in real estate investing. Welcome to the show, Spencer.
Axel, thank you so much for having me. Very excited to be here.
Yeah, absolutely. And we are both in real estate and real estate investing, and in not just doing it for ourselves and build our income and our future life and current life, but also helping other people do it. So can you maybe a little bit tell us the story of how you and your wife basically left the rat race and got to where you are now?
Yeah, happy to. So just for background for folks, I'm based out here in, I think, what many people would call Silicon Valley, actually in the city of Alameda, cool little island across from San Francisco, postcard view of San Francisco. I have two young boys, and I work alongside my co-founder and COO for our leadership team. Jennifer Mormoto is my wife, co-founder, COO, and all the rest. And so we lead Madison Investing. We're a passive investing group of hundreds of people actively investing alongside us. And so this is not a lifestyle that I could have ever predicted, Axel. I think if you were to take me back, 20 years ago, I was not particularly interested in finance. I was a guy who was interested in playing in bands, hence why I have all the tattoos and stuff. And I did.
Oh, you could have well.
I did grow up in a real estate household. I used to be a bit embarrassed about sharing that, candidly, because growing up in the Bay Area, walking down the street with your friends when they're like, "Oh man, what are you doing this weekend?" or "What are you working on?" "Well, I'm going to go work at a tech company," says one friend. I say, "I'm going to go work for my dad's real estate firm." It's just not quite the cool thing. And as silly as that sounds, I was exposed to real estate at the ripe old age of 6 and working open houses by 13 and all those things. And it prompted me to run screaming into tech. And so I had a 13-year career leading and growing teams as an operations leader in fintech companies, which I, retired from, quote unquote, as you alluded to earlier. And so in 2019, October 2019, about 5 months before the global pandemic came and said hello to all of us, that was a labor of love getting to that point, where I could pull the ripcord or, finally make that leap, depending on the metaphor you want to use, to leave behind a career I had worked so hard to build and to serve teams and hire hundreds of people, and starting off at companies that do taxes and back office payroll stuff that usually puts people to sleep. But I look at that career as a 13-year boot camp for all of the judgment, all of the frameworks, all of the processes that we now infuse directly just into how we make decisions about how to invest. And so now we're financially independent, and we're so blessed to be where we are. It was very hard fought, though. And so that's probably more than you wanted.
No, that's absolutely fine. One thing while you were describing kind of part of that journey or the important part of that journey that kind of triggered the question in my mind, were you able to, like in those companies that you were working, to get like stocks that allowed you to then basically cash out and make investments, or did you do investments all along while you're working that career that then allowed you to generate enough passive income? Or can you talk a little bit about, when you say you took the leap? I'm not so much into the ripcord. I don't know if you know, but I'm a retired aviator from the Air Force, right? And if you pull the ripcord, that means you had to eject, and you normally don't want to leave the plane when you don't absolutely have to, right? So No, but I like this taking the leap because that's how it kind of felt to me. I retired from the military and immediately got offered an executive role in a software company, even though I was also not a software engineer or anything like that. Even though, I mean, I was in test flying these very modern jets. So some people said you get to know the bits and bytes by first name. But still, somebody who really learned it and studied it and stuff is a totally different level. But it basically allowed me, in a sense, those two steps to kind of at some point a few years later take that leap. And I'm curious, and our audience is probably curious, why you were in this boot camp, this 13-year boot camp you mentioned. How could you prepare, or what did you do to prepare to actually take the leap?
Yeah, and I have to have a chuckle about the reference that I am speaking to a retired aviator, so I will no longer use that term of the ripcord. That's really funny in some ways, because ironically, we have a repeat investor in our group of the hundreds we work with who is actively doing exactly the role I think you're describing. I'm not a military person, but thank you for your service. And he teaches me whatever I can try to retain about building and testing jets. So it's interesting. Anyways, the journey was like this. We actually look back, hindsight 2020, things seem so much clearer in life, right? And
Right.
At the time when you're investing and carving your own destiny, of course, it's incredibly confusing and disorienting. I didn't know necessarily what investing for things like cash flow meant.
Did you miss that class in high school? You didn't take that one?
Gosh, I'm still waiting for that class. Right? and now as a father with our own kids, I'm sitting there going, I don't think this class is ever coming. So I'd better start doing it ourselves, right?
Right.
So there was really like 3 phases. In hindsight, it's nice to tie it in a clean bow because we can see those milestones across the journey, but I'll keep this brief. They were just so powerful in hindsight what these 3 stages were. And the first stage was, around 2016. At that stage, I had been dumping money into 401ks for over a decade. I was very proud of it. Jennifer and I would celebrate maxing out our 401k contributions, benefiting from company match. And I'm grateful for those things, clearly. I think any company that's going to support their employees in those ways is doing what they should be doing at the minimum. But I didn't understand that 35 plus more years in the workforce was eventually going to seem daunting to me. And also, frankly, we were not putting any of that retirement money towards the impact of our lifestyle now. And very brief aside, before I go into those 3 stages of the process, I just wanted to mention briefly as well, like there was this formative time many years ago. We call it the dark decade in my family. And this is pertinent, I think, for people to understand where I'm coming from and why we did what we did. Because my dad's business that I referred to earlier, real estate broker, only income our household had growing up. We went through a very tough time. I lost my younger brother to cancer many years ago. There was divorces, a couple other family deaths. I don't want to be too grim, but all of those experiences really showed me that, there has to be some kind of moat that I put around my family, if you want to call it that, financially, because God forbid something happened to me, to Jennifer, our ability to earn, our ability to provide. But I watched what happened when my dad's business kind of downsized significantly and it impacted our family. And that was because of outside forces. And so now I was in this phase 1 of our careers where climbing the ladder, getting those promotions, working my butt off and doing 80 to 100 hours a week, literally in office for some of these very early stage tech startups as well, Axel. The intent there was to aggressively learn, but also hopefully find some early stage company equity. Like so many people want to be part of Google and Uber and Facebook when they finally go public. And it's a fraction of the employee base, the actual people working in them, not the VCs that fund them, who really share in that prosperity if it even happens. And so 2016, years into this, my mentor in corporate career just happened to nudge me to work at a property and lending tech company. So I was surrounded by real estate investors who were really flippers, and I was always in awe of how much they would be doing on nights and weekends. And I was managing and responsible for leading these folks. And so I see the zeros behind these transactions inside the company. And I'm like, wow, how the heck?
Is that actually, sorry for interrupting, Spencer, is that what you would say is stage 2, or is that still part of stage 1?
Oh, stage 1. It was really just a precursor. It was like, like kind of getting the memo of like, well, what is this thing people are doing real estate investing wise? And so I finally got the memo. I was like, you know what? I got to go study up. And I educated myself heavily. And we were, we started buying a rental locally. So we bought a rental, $430,000 in Vallejo, California. And that's not cheap. And for $200 a month in cash flow. So that's not what you call a cash flow.
That was still around 2016 timeframe?
Yeah, it was around 2016. I mean, and we purchased our home many years ago in the Bay Area, which is like a Herculean feat because you're competing in these coastal markets.
Yeah, absolutely. And I just wanted to ask because that's basically my story to some extent as well. And, like I mentioned, retired from the Air Force, got this job, and it happened to be in Santa Barbara, which is not the cheapest place in California either.
No way.
And looking around what to do, to build some kind of like passive income, retirement income type money. And to me, I wasn't as brave as you. It was clear by finding a place for the family to live, we were basically not totally tapped out, but to the extent tapped out that it was obvious there would be no way to do that for an investment in the local area. So that's where our strategy to invest using turnkey out of state came from, because, you found a way to do that, obviously. And we were just from the beginning saying, okay, if I can get 4 houses or 5 houses in Ohio or Idaho or Tennessee or whatever versus one in Santa Barbara or the Bay Area for that matter. One quick thing before we go to stage 2, I want to ask you, especially since you said, as you mature and get more and more of the overall picture and maybe past mistakes. I heard you say, I was grateful that the companies matched and all of that stuff for the 401k, but I'm curious for the audience to get to know a little bit of how your views may have evolved over time. I mean this really in a serious way. What is your response today when somebody says or asks, like I'm literally mean to ask you, is it really true that our taxes will be so significantly lower in retirement that this whole notion of deferred taxes really makes sense? And what are your thoughts on that?
Oh man, we could fill an entire separate podcast on that question, Axel.
I keep telling people my opinion, but I would be interested what yours is.
I love this topic. I really do, because I think it's such an important one. And I think it's an important one that is a bit of a heartbreaker the first time someone truly understands and thinks about this all the way through the way that you do and I do now. I look at it as a key financial assumption that every 401k custodian, IRA provider in the world doesn't want you to think about is the fact that your taxes, as they market those products, will be lower because they're assuming in those financial pro formas that you're poorer. And in the end, do they know that that's the case? Well, no one does. I mean, everyone can choose. I intend to not be poorer. I intend to be quite a bit wealthier by the time that I retire. Hence, I'll probably have a higher tax rate. So that's unfortunately for a lot of people a bit of a heartbreaker.
The reason I brought it up, besides wanting to hear your opinion about it, is it reduces, in my perspective, the complexity and wholeness of how life really is.
Yes.
And sometimes, because I'm originally from Germany, I have the opportunity to compare how the two languages, German and English, actually describe things, right? And the term for what we in English call work would, if you literally translate it from German, would be called dependent work, versus what we call self-employment is independent work. Because nobody would deny that you work when you're self-employed and that you work when you are working for somebody else, right? And so when you bring this in the context of 401k, it is basically only reducing the picture to say, okay, your taxable numbers on dependent work will be, and admittedly be, significantly lower because you're not independent work anymore. But it completely removes everything else, right? If you or I or our customers and clients have developed a substantial passive income portfolio, that's not dependent work, right? That's basically independent work or self-work or passive work, whatever you want to call it, if you're even related to work, but it is a form of income that doesn't seem to exist in the eyes of those who only look at 401k in relation to dependent work. And then the other thing that I always like to add, since we always hope that the audience grows and hasn't heard me say this before, is it is a little bit of a stretch in my view, in my opinion, and you tell me what you're thinking. When we right now, let's say we have somebody in the audience, when you're listening to us, you are in your 40s, and we have $30+ trillion in debt. You honestly gonna tell me that with our age pyramid, when you're going to get close to the traditional retirement somewhere between 60 and 70, the government will not have increased taxes, right? Because even if everything were being equal, to assume that in 2030, or in some cases, if we have people who just join the workforce in some way, have a 40, 45, 50-year work career ahead of them, you're really thinking that the few of you will not have to pay more than you and me, Spencer, who have already gone through a good chunk of those 40 years, right? So those two things, limiting it only to depending work and assuming the government will not get more greedy in the future, is really, I think, shining a light of how kind of silly this relatively limited saving is that you get when you do your 401k. Yeah, I'm much more advocate for people to go to your employer and say, question number one, ask your employer, do you like an independently, critically thinking employee? I only want to hear yes or no. Most would hope that the employer says yes. When the answer is yes, to say, well, then if I am investing in the category that I'm interested in, like, for example, real estate, why wouldn't you then match me just as you match me if I invest in an index fund that is sponsored by some company you signed a contract for?
And most HR departments
Right?
would not be happy to field that. They probably wouldn't know how to answer it, frankly.
No, but the point is, right, like the match should be for you to do with your money and the support that they want to give you to a certain percentage for your future life.
Yes.
And not because we signed with Fidelity or Vanguard or whoever we've signed with. You basically, if you want to participate, have to do what these people say.
Oh, man. And the history you provided there on just the education and the layer beneath about the why, like why you and I both believe that it's likely the government probably will get more greedy, because history has taught us that. In addition to the fact that, without going too far down this, I mean, frankly, I find this to be fun to talk about, but I know some people are probably not there quite yet to where you and I are at and finding this really exciting to talk about. But like, you look back, this is one of the lowest historical tax periods in the United States. And so like,
Right.
where does it go from here? You know,
I even go one step more aggressive and say, with 30 trillion in debt, there's only two options. Either we increase taxes or we get rid of the dollar.
right. Not very likely for the dollar to go away, right? At least not right away.
No, but it has already lost 99% or 95%, depending on how you calculate it, since the Fed was established in 1913.
Right.
So there isn't, from a buying power perspective. So it may not be completely go away, but one way, I mean, we're playing this game right now, is inflated away.
Yeah.
Right. So, but not to get stuck on stage one. Tell us, Spencer, and the audience, what's stage two?
Yeah. Well, I appreciate you taking us there, though. I think that is clearly where the vast majority of people that want to begin investing for things such as cash flow that you and I take for granted now, perhaps in our lives, because those checks come in monthly from investment properties we own or from private investments we've made, for me, and syndications and funds. So phase one was we buy local because we're too scared to go buy something we have not seen in person. In the bottom line, education and buying a local rental for too much money, not realizing, oh, wow, we just paid $100,000 plus cash with a loan to buy $430,000 properties. So then we said, our money's going to run out. Our capital will be exhausted. We are not stretching our dollar far enough. So this is more your wheelhouse. We ended up going and building a portfolio of up to 5 different turnkey properties in Kansas City, Missouri. And those were cash flowing $250 per month for a $60,000 purchase price.
Yeah, exactly. They could probably not quite compete with equity gains that you made in the Bay Area, I'm assuming.
That is true. I mean, I always try to give a soft landing and let someone down easy, particularly our friends who are exclusively involved in the real estate network of California. And I just tell them, yes, we are not planning on moving. We love it here. I know the real estate investing community has so many wonderful feedback points. I'm saying that very sarcastically about California. But frankly, I love it here. I love living here. I'm born and raised here. And I will say that the appreciation we've gotten from that rental could have purchased every single one of those combined, all of our rentals combined from outside of the state. But there's no cash flow for how much you put in. So
yeah. Can I say one quick thing about that?
Oh, yeah.
I'm in San Diego now. It's a little bit a gratification that you receive if you do your investments right? Because I think you and I, there's no doubt, would agree that living in California is expensive.
Oh, my goodness, yes.
Right? Well, if you do the right investments for the right amount of time, your gratification is to be able to live in California.
That's right. You kind of pay to play in more ways than you tend to realize, including on the taxation front.
I mentioned earlier this kind of literally translated German term of dependent work.
Mm-hmm.
Right? When you use dependent work to make investments, you gain that independence that allows you to say, okay, I want to live where the weather is nice, technology is there, and other things are there, even though a lot of people complain about it. But I believe that to some extent, and large extent, they complain about it because they have not taken those steps.
Oh, my goodness. You are talking my language, Axel.
Yeah, I mean, they're literally on the suffering, or I call that the victim side in our mindset manual that we created for our people who are considering if they want to work with us. It's really to say, find out, are you in the victim stage, or are you in the stage or want to go into the stage where you're the creator of your life and your life story?
Yes.
And when you make that transition, and the people who want to leave or complain are typically in that victim stage, right? So
completely agree.
All right, so let's go to the 5 properties in Kansas. How did it go from there?
The lesson you learn about that type of vehicle, and we learned this as well, was that they cash flow incredibly well for how much you invest, cash-wise.
Right.
But if you're investing for that cash flow, you're still managing the manager. You're still dealing with occasional rental property things. And so will we go back and purchase more of them eventually? Probably, yeah. But with our young kids, thriving business, busy life, social network, life was very, very full. And so we opted to sell those properties because we realized, you know what, we're just too busy. We wanted something even further passive. And so we ended up looking at these syndications, like for large multifamily. And that was phase 3, is when we first started jumping in, deploying our own money into big apartment buildings in places like Dallas, Texas, all the way down the Sun Belt through North Carolina, South Carolina, Atlanta, Georgia, et cetera. And so that really, lit the fuse for us in realizing, the due diligence on the front end is really key. But once you do that, you vet the who, meaning the team managing it, the where, like what market, submarket, neighborhood, block, all the way down there. And then really just what's the plan? What's the business plan behind this big thing? Buying this big apartment building was very intimidating because we didn't have $20 million to go buy one of these things for hundreds of units, of course. But then we realized you could buy a piece of one and own a piece of it along with many other people. Once we got over the ego hit, which I see so many of our investors get stuck on, which is we owned those single family rentals. That was ours. The title was in our name. And I was like, is it better to own that property fully, or is it better to own a piece of a 200 to 300 unit apartment building and get over the ego hit? Because in the end, it's more passive for our unique goals at this time, while also reaping the full benefits of the cash flow and the checks that would come in monthly. So that was phase 3. And that was it. It was like, buy local, too expensive, was not cash flow goal setting well. Step 2, go outside our state, find something more affordable, better cash flow, a little bit more work, a little overhead. Step 3, sold the rentals and kept the one in California, still appreciating, and then start investing passively in these syndications and funds. And that was really just the foundation of what ultimately became our business, Axel. Because, frankly, there's so many wonderful and capable asset management, real estate professionals, people in Texas, Georgia, North Carolina, South Carolina, Florida. They know their real estate stuff. They know how to find great deals. They know how to manage these assets. They know construction. I can't swing a hammer. I just can't. Yeah. YouTube saves me every day around our house. Yeah.
I can't even imagine how it was when it wasn't there yet.
Oh my goodness, right? And so I looked at, what can we bring to their partnerships? And so that was kind of the genesis of what started our whole passive investing group, is other people started asking us what we were doing with our money. And as I explained it to them, they were like, well, could you just help me do that? And there you go. Kind of the rest is history at this point. We've done that, 37 deals at this point.
Yeah, and I want to point out for people who are interested to kind of get a little more granular what it really is. In preparation for our conversation, I looked, and I think you have a really nice way of showing the properties and stuff on your website without, making it very confusing. But one thing I have to ask, and maybe I just didn't read it when I looked at it, is why is it called Madison?
Oh, why is it called Madison? Oh, yeah. We used to live on Madison Street. And so, ultimately we were like, do we want to call our business Madison Investing? because that's where our family was built. And we actually purchased a few of our early investments with some of the equity we had built from that home. And as we all know from the past 10 years, the market has gone incredibly well. And so none of this would be possible without that. So that's why it was on Madison Street. We don't live there anymore. We actually purchased a new home earlier this year. So
I went back and forth in my mind if I should preface it in who is Madison, but now I know what is Madison is actually more appropriate. Because I thought maybe that was actually literally I did a consulting project quite a few years ago, because I still do consulting on the side. I guess I have still not learned to say no in some way, but that lady had actually called her company that had become pretty successful in Oakland actually after her first dog.
Oh, that's cool. I mean, if it's a personal connection, personal story, I always feel like that means more to the person making it, right? And so it means a lot to us.
Right. Yeah. No, absolutely. And I mean, I find it kind of interesting. It's kind of to the roots, right? Of, this is where we started and we want to keep that in memory. So it's totally cool. In our case, typical German fashion, I used 2 abbreviations and made a term out of it.
Well, it's practical.
Yeah, maybe engineering mindset, right? So ideal is an abbreviation for all the benefits of real estate, and grower is the mentoring and coaching methodology that we use. And what we want to do is in the middle is generate wealth, right? So ideal with grower is coming from that. But I think using your street address or where everything started is a very cool thing as well.
Thank you.
So you kind of built a quick bridge there in your last response by saying, okay, this is where we are now, and we're benefiting from 5 years, probably more like 10 years, I would almost say, of, after the financial crisis, almost continuous growth in real estate valuations. And now even more so from a cash flow perspective, the rental appreciation that I think is just really only started. If you ask my opinion, I think there's way further to go, even though I think there might be a social issue brewing there that a lot of people might not have on their case, because we've always argued, and I'm sure your clients and in your environment, it's always argued when we're looking at the financing, how much of your income are you going to dedicate, or will the banks and lenders allow you to dedicate to shelter, basically, right? Especially when you include the insurance and the mortgage payment and property taxes and all of that. In the Bay Area, I don't even know the numbers anymore, but most places I would say it's probably 50% or so in that ballpark. So from a rent perspective, I think people have often argued that, they don't want to or can't afford or don't foresee to spend that much on rent. But in certain places in the country, and I think more and more so going forward, that will become the reality. It might even go further than 50% just for rent.
Yeah, so very well could.
All right. So with looking at where we are right now, you've been running the business during basically low interest rate times, also for your syndicators, right? They could get the money for these larger, what's called commercial residential projects easier, and the numbers worked easier. But now we have high inflation. We have a Fed that is determined to get us to unheard of for generation interest rates. So the first question maybe about the current environment, I would be interested in your opinion, is the correlation between real estate loans as far as interest rate goes and the Fed rate. Where do you see this going? Because I want to preface it by saying I think real estate loan rates have jumped ahead of where they should be realistically compared to the Fed rate. But what is your thought on that?
Yeah, I have to give my obligatory disclaimer, like everybody else, that I still own no crystal balls. I do not know which way is up on where we'll be in 6 to 12 to 24, 36 months. But, in layman's terms, as you just outlined as well, money just got more expensive, right? And I think many of the deals that we have focused on, because we have largely focused on and invested in value add deals. And value add is, you already know this, but for the audience as well, that just means you're not building something from the ground up. You're basically buying something that's there. You're buying a 200-unit apartment building or a self-storage facility somewhere. And then you're adding value by pulling 2 levers typically. You're going to go and renovate these facilities, or you're going to also plug in new management, make it more efficient.
Right.
And so that business plan jives with me and our approach typically because I like predictability. I mean, you and I probably have this in common, I think, Axel, which is I like things that can be forecasted with as much precision as the data will allow. And so that's really what I like. And so going into these deals for the last many years now, we'll always take a snapshot at that moment, right? The numbers reflect, oh, we're going to go borrow. The team we're going to invest with is going to borrow this amount, millions of dollars at that rate. Now, the thing that's tricky on these value add deals is that you're often going to be doing a lot of those renovations, and those renovations mean you can't get the very attractive, super stable Fannie Mae, Freddie Mac, what's called agency debt, usually, because they want to see that thing full above 90%. They want to see it full of families and everyone paying rent. At the time that we've purchased these buildings, most are at that level. Actually, all of them are at that level. So they're stabilized, AKA over 90% occupied when you buy them, usually even higher than that, 93, 95% and up. But you have to plan for that dropping while you renovate these units. People can't live in a construction zone. And so as that occurs, you're probably going to need to get a different kind of debt. And so a lot of the debt that's been used or loans that have been taken out have been bridge loans, bridge debt. And so on the apartment buildings, on the storage facilities, if those are actually going to be bridge loans, you're starting to see different things that are being put in place structurally to allow for these to still make sense if the deal pencils. Like, can it produce cash flow? And to answer that question, you just have to run the numbers and say, well, we can't assume anymore that in a year and a half, we'll confidently be able to go do a cash out refinance or put a new loan with a simple fixed rate loan once the building improvements are made. Some of that has to change, and some of that has to change not completely, just has to be increased and structured with things that limit the risk and mitigate the risks. Things like interest rate caps. You can purchase things like these and put them into the deals. So without getting too much nerdier for people, because that was a very nerdy answer in what I think is exciting, I think that for these deals and in general, stepping back to your question about correlation, I used to think many years ago, as most people probably do when they read these headlines, if they don't know anything about real estate investing, they're early in the journey, they might even think, oh, this headline says the Fed is going to raise interest rates. They might think that means the same darn thing as the mortgage rates. And you and I both know they're different. They correlate, but they're not the same. So do we think that that's going to keep going up? I actually don't think it's going to keep going up in perpetuity. I mean, certainly not perpetuity, but even I don't think it's going to keep going up, not because I'm blind optimist kind of guy, more so because this is what I've heard from enough smart people, economists, experts, and beyond, that we will hit a point where inflation is going to plateau and hopefully come back down as well from all these interest rate increases. And so I don't see that necessarily going on long term. I do think that mortgage interest rates, if you compare it to where we were in the 80s, are still compelling compared to that historical high relatively. But I think for real estate investors, this is also one of the reasons why, stepping back from multifamily, for example, and storage, we started to look broadly. So we actually focus on investing not just even in real estate. I mean, cash flowing other alternative niches to complement the whole, so like we're actually talking to our investors quite a bit and putting our own money into these types of deals as well that produce many of the same qualities, like cash flow distributions on a monthly basis so that passive income is still realized, but great deals are out there. In a recession, it doesn't necessarily mean that, the deals are gone. It just means there's fewer of them and they're harder to find. So you have to put more work in.
Yeah, absolutely. I mean, two things maybe to put my spin a little bit on that. For one, I want to say I totally agree with you and your assessment of that. Besides the kind of crystal ball question of how far will the Fed go, and in tandem to some extent associated mortgage rates, and you explain why you believe that they don't or can't go up or very much higher. They can probably incrementally keep increasing, but not to extreme levels. One of the things for our audience in general, and also for your audience, is if you look at the scenario a little bit bigger picture, you can say with the debt that the government has, we paid in 2021 around $560 billion purely on paying the interest on the debt. And that was a debt that was on average interest rate somewhere between 0.25 and 0.75%. So let's call it 0.5%, right down the middle. And we're now talking with the impending increase of the Fed, most people saying another 75 basis point increase. We will probably be ending at the end of this month, early next month, in the like 3.5% area. Now you might say, okay, so that's 3% more. But that's not true. It's literally, if you really think about it, how often does 0.5% go into 3%? It's 6 times as much. Right? Which means if we paid 560 billion, we, all the taxpayers, pay this in interest on our national debt, just the national debt, then we have to pay 6 times as much next time, right? At 3.5%. I mean, you can do the math. That's almost that's $1 trillion in payments just for interest. And we're not stopped adding more debt to it. So that combination, right? Besides the, can we actually catch inflation and maybe get it to lower again more towards the 2% the Fed is talking about, is it becomes, in my view, an affordability issue.
Totally.
How can we afford $1 trillion, or maybe if they keep increasing more than $1 trillion just purely in interest?
Yes.
Right. And besides the fact that you get to this situation where you have to get a new credit card to pay off the old credit card because there isn't even that much tax income that the government makes to just pay the interest on the already existing debt, let alone pay for any kind of welfare programs or any other expenses that are already locked in. Right. So that mechanism where we have to look at, okay, how can we run this business called United States? There is a limit on, how much debt any company, even if it's a country, can put on and then afford to pay interest on without basically locking itself down in no more ability to be innovative in any way or invest in anything or pay for anything and so forth, while we at the same time have this aging population that gets bigger and bigger and wants to see social security and all these other things that basically are locked in as expenses. So for me, that is, I agree with you that there is a limit to it, but I think the pain will first get worse before it starts getting better again. Now, one thing I think we want to touch on before we close is what you pointed out, and I think it's really important. I would like to hear if you agree with that notion, is when I talk about real estate investing for passive income, my point is rarely about how much does it cost or how much is the interest rate on the loan or so forth. It's almost always, how does this property perform? Right. And so we touched earlier on the fact that, yes, money is getting more expensive, like you said, for the renovations of these assets that you and the partners you work with buy and then bring them up to standard, put in new management and so forth. But I wonder, when you take the saving grace of increasing rents, can you explain, because I obviously explain it all the time for residential real estate that is like 1 to 4 units, but on your large 200, 300, 400 units, when it comes to the valuation and the associated performance, how that works so people understand there is the cost, but then how do we actually calculate the value of one of those 300 unit apartment complexes if we want to exit?
Absolutely. Yeah, fun topic too. And this was one of the first things that drew me, by the way, before I share just the math behind it. This is what drew me a bit in the context of investing for bigger deals to these big properties, because I used to work inside of a lender, for example, who would lend on single family homes to real estate investors. It was at the biggest hard money lender in the country at the time. It was 600 loans per month made across the country. And so those properties were, every single family home is valued based upon things such as sales comparables. So within a very close proximity, within reason, how much did that property on the street sell for? And most people are familiar with that. But on the big buildings, it's actually more like a business. And so it's valued as a business based upon something called the net operating income, the NOI. And that's a function of, well, how's it doing? How's it producing operationally? And how much demand is there in that market still? So you still have that element of comps and comparables, but not in a vacuum. You have it along with how much is this property producing as a business? And that's where that rents number comes in. And it's so darn important as well to you, exactly your point, Axel. And I love that you brought us here to this point, because along with those rents increasing, that is the biggest source of income for these businesses, also known as buildings, apartment buildings, right? And self-storage facilities. Could also be an industrial building, could be a senior living facility. I stick to my swim lanes of multifamily self-storage, but those are priced as businesses based on how they produce. And so by the time that you've done those renovations, you've plugged in competent, experienced property managers, they've appropriately, responsibly raised rents along the way, you go back to a lender, to a bank, and you say, here's what we have, and we want you to price this thing, value this thing. They come back and they say, oh, okay, let's look at your profit and loss statement and see how you guys are doing. And then they assign a value to that. And so that is really where it's all about when people want to get the more attractive outcomes from these, because getting cash flow per month is wonderful, but getting a big sales proceeds check at the end of these is also quite a bit satisfying. And so that's why it's so important to understand how they're valued as a business.
Yeah, absolutely. And I love that you explained that in a nice, easy to understand way. When we put numbers to it, just for me and for anybody who is kind of wondering what does that really mean, if you take 300 unit place and everybody just say they're all the same and everybody pays $1,000 when Spencer and his team come and buy it, that's roughly $3.5 million in revenue. You go and you fix it and you can now say, okay, we get $1,300 per unit in rent, right? So then you basically go from 3.5 million to probably closer to 5 million in that ballpark. But I heard that you said in the beginning, well, then we're also keeping these stabilized properties for like 3, 4, 5, 6 years. And that's why I pointed out in the beginning, this environment that we're now in and probably going to be in for quite a foreseeable future, where people will just not qualify, even if they have the intention to buy a house that they want to occupy, due to the increased interest rates and higher security requirements by the banks and lenders. So their option is to rent.
Yeah.
Right. And that means the more people, it's just simple supply and demand, yes. The more people are intending to rent, the more the rents are competitive. And so you might say, well, we're planning for 1,300. But you find the market by the time everything is stabilized, just let's be super ambitious and say it goes to 1,500. And so now then basically you have a third more overall or 50% more than you had before. So you go from 3.5 million to 7 million, right, in annual revenue. And that's obviously if you go to a bank, regardless of the interest rate.
Yes. Oh my God.
Okay, we're making 7 million a year. Who wants it? Right? There are probably other people out there who give a pretty penny to make 7 million a year in revenue, especially when it was 3.5 before, right? So that's, for me, the numbers sometimes can tell a really good story and transport the fact that, yes, there was a purchase price and yes, there is a loan with a certain interest rate. But when you really focus on performance, and that's the same in our business with the residential units, right? If I can get the unit for close to a 1% deal on a renovated unit or maybe 0.8 or so for a brand new build unit, and I'm in an environment where more and more people look for a nice, let's say, what we're investing in right now is new build properties in Memphis for working class families at about $1,350 for rent for brand new house, right? Which is 0.85 in the ratio. And rents keep increasing 7, 8, 10% a year. It doesn't matter really whether I buy it now at 6% interest or I bought it a year ago at 3.5% or 4% interest. The performance is ultimately.
Oh man, you got to yell that from the mountaintops. I really agree with that.
Okay, very cool. So now coming towards the end, I always ask, if you had a time machine, Spencer, it has nothing to do with real estate. If you had a time machine, you could go forward, backward, you can come back, obviously. You know everything you know. The only thing you're not allowed to do is change the time-space continuum. Where would you go and why?
Oh, where would I go and why? Oh my goodness, this is going to be way too sappy and personal of an answer, probably. I would just go back to the earlier years of my nuclear family, spend time, meaningful time with loved ones lost, of course. And I think it also coincides coincidentally with a time when I could grab my younger self by the shoulders and simply say, hey, dummy, go and stop renting the most expensive apartment in Denver, Colorado in 2009. Go buy some property instead, dummy. I'd probably go do that.
I was thinking you would actually say, I would go down the street with these buddies in the tech industry and say, you have no idea what you're going to miss out on.
Yeah, that's true. That's true. I mean, I probably would have a bigger multiple if I went that direction on my investments too.
Yeah, exactly. All right, very cool. Well, you mentioned that you guys are working on some tools and some things that people will probably appreciate, and they want to get a little bit better understanding how this stuff that you do with these like 300, 400 unit complexes or storage units really work. So I want to give you the opportunity to basically pitch that real quick and tell people how they can get in touch with you.
Yeah, happy to. And thank you so much for having me on. This was a really fun discussion, Axel. So we worked very hard at Madison Investing to curate and just synthesize all of the learnings that we got ourselves as passive investors that have now done this dozens and dozens of times with their own money, and brought us to a point where we're financially free. And we help hundreds of other people do that. So we put together our first free resource that is the blueprint for passive investors. And it's available on our website. And so folks can go and check it out and download it. It's like a no obligation thing. So it's really just intended to arm people to make great decisions. And it's just timely in ways that I never thought would have been needed in the year 2022. So yeah, very excited to share that. If people go to madisoninvesting.com, then they can sign up for our newsletter. And if they're an accredited investor, that means they can also look at the deals that we share. They will have to speak with me on a phone call because I do onboard every new member personally. And it's a commitment that we made right from the very beginning.
Okay, very cool. Yeah, that's good. And we will put obviously the link to the blueprint and the website and any other things that Spencer is going to give us to get in touch with him in the show notes. And then people can actually reach out and find you. And so I think in summary, Spencer, I want to really thank you, because what we hopefully were able to transport is that in this overall environment of investing, especially in real estate or in value assets, that there are so many different ways to make it work. And I'm always emphasizing, as long as you can confidently say or have somebody who can help you figure out that there is good performance in the deal, then even when things change as they have this year, there are still good deals out there. So I want to invite you, any last words before we close?
I would encourage people to be curious. And I think being curious at the most basic level, Axel, now is the time for that. And by be curious, of course, in all aspects of life. But I would say, if we're talking financially, don't read the headlines and let that freeze you. Don't let it drive analysis paralysis. Now is not the time for that. Inflation is killing your dollar. So be curious and go out and there's so much wonderful education, just like your show right here, Axel. And I hope that people get a lot from this episode and look far beyond that. I read 24 books in 18 months when I first got into this journey. No one has to go do that. Just start with one and go from there.
Awesome. Yeah. Thank you. And thank you for being on the Ideal Investor Show, Spencer. It was really fun to have you.
Oh, it was wonderful to be here. Thank you so much, Axel.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.